Hi, I'm James Robinson, and this is my stock pick of the week. This video is part 4 on my series on Blackrock. Today we're going to talk about dividends. So here you can see a chart of both the dividends, which is the total amount of dollars the company's paid in dividends, and the dividends per share. So the dividends have gone up pretty dramatically. They've gone up pretty consistently as well. It looks like there's been 1 year in the recession of 2008 where they did not increase, but other than that, every year they've gone up. Since about 2012, they've quadrupled, going from paying $500 million in dividends to just under $2 billion in dividends. So this company's a very solid payer of dividends, and I think it's very consistent. It's consistently grown their dividends. When you look at dividends per share in the last 10 years, it's gone up faster than the dividends have, because in the last 7 or 8 years, they've really bought back a bunch of stock as well. As always, when we look at dividends, we don't just look at what the company's done historically in dividends. We don't just look at the fact that the company is paying dividends and that those dividends are increasing. We try and look at how safe those dividends are. What's the likelihood the company is going to be able to continue to pay those dividends through good times and bad times? And one factor that I always look at is what happened in the recession of 2008. 2008, the company had 1 year that was flat in that short sort of 3 or 4 year recession period. It had 1 year where the dividends were flat, and then every year prior to that and since then, the dividends have gone up. So seems like it's a pretty recession-resistant company. But we look at, in terms of dividends, I look at 4 factors. You look at yield and growth. I look at dividend safety in the context of earnings. I look at dividend safety in the context of cash flow, which sometimes tells you things that earnings doesn't. And I look at dividend safety in the context of the company's current debt load. So if interest rates were to increase dramatically, would the debt load be such that the company could no longer afford to pay the dividends that they pay? I've been interested in Blackrock for a very long time. It's a company that I think is very well run, very well financed. It's in a good industry. Unfortunately, a lot of other people felt the same way, and so the stock was out of reach for me in terms of its stock price. However, with the coronavirus, that's changed. The company is now very cheap relative to its merits, and so I've decided to buy it. Also, as a result of the price coming down so much, the company's now paying an exceptionally good dividend. The dividend yield as of the day I did this analysis, which was last Friday, was 3.28%, so about 150% of what the historical S&P 500 average has been. It's actually about 200% of what the S&P 500 average has been. More importantly, or just as importantly, the dividend growth in the last 5 years has been 12.9% a year. So if you buy this stock as part of your retirement plan, it looks like you could expect that you would get a raise every year as part of your retirement plan. So I think that for dividend investors, that's an important consideration. So dividend safety in the context of earnings. If a company pays 100% of their earnings out in dividends, then that works until something bad happens, in which case the company has to either start going into debt to continue to pay dividends, or the company has to reduce the dividends. When the company reduces dividends, that has a deleterious effect on the stock price, which is disproportionate to the amount that the dividends were cut. It really means that the whole class of dividend investors who will sell the stock in favor of greener pastures. And so what we like to see is that the company is paying a dividend that is proportionate to their income, but not too much of their income nor too low of their income. That ratio is called the payout ratio. The current payout ratio for this company is about 46.8%. The average payout ratio for the last 5 years has been 43.7%. The average payout ratio for the S&P 500 is about 40%. So this company is paying a little bit more, but not significantly more than the average company in the S&P 500. They've done a very, they're pretty conservative with their dividends, and that means that we don't have this big concern that when the coronavirus hits and their earnings get hit by 30 or 40%, that they can't pay their dividend. They'll still have enough money to pay their dividend. The payout ratio would be higher in that year, but in theory, the coronavirus will pass, earnings will normalize, and they'll be able to continue growing the dividend, but they won't have had that period where they cut the dividend, which is what really hurts investors. This slide is dividend safety in the context of cash flow. So the reason that I look at this, and a lot of people don't really understand cash flow and don't analyze it, and I can't, I'm not an accountant, so I don't have an accountant's understanding of it, but effectively, a company's earnings can be manipulated. A company can make decisions according to general accepted accounting principles, which will allow them to some degree, manipulate what their earnings are. Cash flow is harder to manipulate. Cash flow is simply the money that comes in gets recorded, money that goes out gets recorded, and those numbers are what they are. And so when I look at this slide, because I know a lot of people don't play around with these numbers and don't understand them as well, I go into them a little bit, I go into the slide a little bit more in depth. So looking at the year 2019, cash flow from operations was $2.8 billion. The company had capital expenditures of $254 million. That left free cash flow of $2.6 billion. And the dividends they paid were $2 billion, which meant they paid 79% of their cash flow in dividends. The average amount that they paid in dividends for the last 5 years is about 63%. 50% is sort of the number, but that the average company, the S&P 500 pays. So these guys payments, dividend safety in the context of cash flow, they're slightly less safe than the average S&P 500, but I would argue that the company needs very little capital. And because they need very little capital investment, they can afford to pay out a little bit more in dividends. I would also argue that the company's been growing their dividends and their income so prodigiously over all this time that this is not outside of the margin of safety. It's very, very safe. And by the way, if you see too low a number here, that means the company tends to be either really having a tremendous amount of capital expenditures, which would be bad, or they're hoarding cash, which at some point as a shareholder, I want the money coming back to me. So this is not out of line. This is not something that bothers me. I'm very comfortable with the 79%. I'm frankly much more comfortable with the 63% over the last 5 years. But there's no reason to look at BlackRock where the jaundice died because their dividend payout ratio for cash flow is just a little bit high. Another issue that I like to look at when I'm analyzing a company's dividends is the dividend safety in the context of debt load. And what I'm really saying here is, okay, we know what the company's debt is and we know what their interest payments currently are. But what if the cost to borrow money were to increase? And what if it was to increase dramatically? At what point would that increase in borrowing costs start to impinge on the company's ability to pay the dividends? So if you look at they're paying just over 4% in interest in their total portfolio of debt right now. But if it was to go to 5% interest rate, for example, then the company would have to spend an extra $44 million on interest. And if it went to 10%, you can see they'd have to pay another $292 million in interest. So at some point, that extra interest payment starts to make it harder and harder for the company to pay dividends. So we know that the company's interest-adjusted cash flow at 4% would be about $2.6 billion. And that as the company pays higher interest, that number would decrease. We know that the company pays $2.096 billion in dividends currently. So we know that the free cash flow minus dividends today is about $538 million, but that number would decrease as interest rates go up, right? So if you look down to the 15% load, at 15% in debt, 15% interest rate, they'd have to pay $540 million in debt in interest payments. They only make 2.8. They'd have a interest-adjusted cash flow of 2.89 billion, which means that after dividends, they'd be losing about $6 million. So the dividend payout of cash flow at that point would be paying 100% of it. So we say that when I would look at this, what I'm really saying to you is, if interest rates get to be 15%, this company's going to have to cut their dividend. Now that's maybe obvious, and you say, okay, fine, interest rates aren't going to get to 15%. And by the way, if they get to 15%, we have a lot bigger problems, and that's all true. What I'm really pointing out, maybe the flip side of that, is this company is safe and able to not change their dividend payment until interest rates get to 15%, which means that I don't think that debt load in today's interest rate environment is really a problem for this company, and it's very, very safe. Most of the companies that I invest in have very little debt, and this isn't a problem for. But one day I'm going to do an analysis of sort of the average company, and you're going to be sort of surprised when you see these numbers, and you're going to understand why I do this research. So that covers it for the company's dividend payments. Dividends have been going up dramatically, about 12% a year, almost 13% a year. They've only had one flat year for dividend payments. That was during the recession, so they didn't go down during the recession. Dividends per share have been slightly outpacing dividends as a result of the company buying back some stock over the last 7 or 8 years. So that's good. The yield is 3.28%. The S&P 500 is about 1.73%, or at least it was before the coronavirus, and I sort of assume we're to come back to that level over the next year. Dividend growth, as I said, has been 12.9%, so very, very strong. The current payout ratio is 46%. That's in line with the S&P 500, just a little bit high, but not out of line for this industry. And the average payout ratio has been 43%. The company pays 79% of its cash flow in dividends. That's a little higher than I'd like, but their average for the last 5 years has been 63%. That's a little more in keeping with what I'd like. But the company has very little capital expense requirement and very little debt, so I'm reasonably comfortable with that. And touching on the debt, until interest rates reach 15%, debt shouldn't be a mitigating factor in the company's ability to pay dividends. So BlackRock is today, in today's environment, if you buy this stock, it's paying a great dividend of 3%. That dividend should grow, and the dividend seems to be very, very safe. So that does it for BlackRock's dividends. Thank you very much.